Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The GPU shortage dominated trading narratives through 2025. As of February 2026, that bottleneck is largely resolved. But here's the critical insight. Solving the compute problem exposed a cascading series of deeper infrastructure constraints across memory, storage, networking, and power. Each time the industry fixes one choke point, the next limitation emerges. This is reshaping capital allocation across semiconductors, cloud infrastructure, data center operators, and utilities. Let's break down the cascade. The compute constraint is easing faster than most analysts expected. Major cloud providers deployed proprietary accelerators that reduce dependence on traditional GPU architectures. According to SemiAnalysis, Google's TPU v7 systems are projected to ship between 3 and 7 million units annually from 2026 through 2028. Microsoft's Maya 200 processors, deployed as of January 2026, deliver 3 times the performance of AWS's Trainium chips, according to reporting from TechBuzz AI. Amazon responded with next-generation Trainium 2 and Trainium 3 processors, achieving 30 to 40% better price-to-performance ratios compared to traditional GPUs. Meta's MTIA, their Meta Training and Inference Accelerator, now runs live across 16 regions and operates 3 times faster than its previous generation, according to Meta's official blog. These proprietary solutions collectively relieve the compute bottleneck. So what's the problem? The problem is what comes next. High bandwidth memory, or HBM, is now the most critical constraint in AI infrastructure. All major HBM suppliers, Micron, SK Hynix, and Samsung, are completely sold out through 2026 according to Introl's analysis of the AI memory supercycle. Prices surged over 50% in the first quarter of 2026 alone. The production economics reveal a fundamental constraint. For every 1 bit of HBM produced, manufacturers must sacrifice 3 bits of standard RAM production capacity. HBM and standard memory share manufacturing processes and equipment, forcing difficult allocation decisions. SK Hynix currently supplies approximately 90% of NVIDIA's HBM requirements, creating massive concentration risk in this critical supply chain. New fabrication facilities capable of addressing this shortage won't come online until 2027 through 2030, creating a multi-year supply gap during explosive demand growth. The memory market is experiencing what analysts describe as a supercycle. Total addressable market projections show growth from $35 billion in 2025 to $100 billion by 2028, according to Introl's research. That's annual demand growth rates of 70 to 130%, straining an industry built for predictable growth patterns. This has direct trading implications for memory suppliers and their customers. Companies with secured HBM supply chains hold operational advantages, while those dependent on spot market availability face significant risks to production timelines. Now let's talk storage. Enterprise solid-state drives emerged as the next critical constraint as AI workloads shifted toward inference, which now accounts for 80 to 90% of overall AI compute. According to Pure Storage's analysis of CES 2026, SSD prices surged 257% from the second quarter of 2025 to the first quarter of 2026. High-performance enterprise models now face delivery delays exceeding 12 months. NVIDIA's announcement at CES 2026 of its integrated cache memory storage platform underscores the inadequacy of traditional storage architectures for AI workloads. The platform offloads key-value cache operations to NVMe storage, representing a fundamental shift in how AI systems manage data access patterns. Traditional storage was designed for conventional workloads with predictable access patterns. AI inference creates entirely different demands, requiring sustained high-throughput access to massive datasets with minimal latency tolerance. This storage bottleneck is reshaping valuations for enterprise storage providers and creating opportunities for companies developing AI-optimized architectures. Network infrastructure is approaching capacity limits. AI servers require bandwidth levels approaching 30 terabits per second, roughly 300 times higher than traditional workloads that typically operate at 100 gigabits per second. This dramatic increase in bandwidth requirements is driving rapid deployment of 800 gigabit and 1.6 terabit optical networking equipment. Multi-site AI clusters present particular challenges, requiring lossless connectivity over distances of 10 to 80 kilometers. Co-packaged optics, or CPO technology, is emerging as a solution offering 3.5 times better power efficiency compared to traditional optical networking equipment, according to Pure Storage's infrastructure analysis. The network infrastructure challenge extends beyond individual data centers to the connections between facilities. Large-scale distributed AI training requires coordination across multiple sites, placing unprecedented demands on wide-area network infrastructure never designed for these workload patterns. This creates trading opportunities in specialized optical networking equipment, manufacturers, and fiber infrastructure operators positioned to support AI connectivity demands. Power infrastructure represents the ultimate constraint on AI expansion. According to Morrison Foerster's analysis of AI trends for 2026, AI data centers consumed 4.4% of total U.S. electricity in 2024. Current projections show this rising to between 6.7 and 12% by 2028. Here's the mismatch that matters for trading. Data centers can be constructed in 18 months, while transmission lines require 7 to 12 years from planning to completion, according to reporting from Enki AI on NVIDIA's power challenges. This timing disparity means power infrastructure cannot keep pace with data center deployment. The interconnection queue in the United States currently contains 2,600 gigawatts of proposed capacity, more than double the current total grid capacity. Individual AI racks now consume between 30 and 120 kilowatts compared to 7 to 10 kilowatts for traditional server racks. This 4 to 17 times increase in power density creates cooling and power distribution challenges, extending beyond simple capacity questions to fundamental facility design requirements. The cascading nature of these constraints is reshaping investment priorities across the technology sector. Companies with secured supply chains for HBM and enterprise SSDs hold advantageous positions. The memory market transformation is particularly striking, with established suppliers unable to meet demand despite operating at full capacity. New entrants face multi-billion-dollar capital requirements and multi-year development timelines, creating barriers perpetuating current supply constraints. Network equipment manufacturers specializing in high-speed optics and co-packaged solutions experience unprecedented demand. However, the specialized nature of AI networking requirements means traditional networking companies must develop entirely new product lines to address these workloads. Power infrastructure constraints are creating geographic concentration in AI deployment. Regions with available grid capacity and favorable regulatory environments attract disproportionate investment, while areas with constrained power infrastructure are bypassed despite other advantages. This has implications for data center REITs and utilities positioned in power-advantaged regions versus those facing grid constraints. The research indicates the 2026 through 2035 roadmap for AI infrastructure will be defined more by physical constraints than algorithmic limitations. Success in AI deployment increasingly depends on securing integrated solutions across the entire infrastructure stack, rather than optimizing individual components. The interconnected nature of these bottlenecks means addressing one constraint without considering others simply shifts the limitation rather than resolving it. Organizations planning large-scale AI deployments must develop comprehensive infrastructure strategies accounting for the entire supply chain, from semiconductors to power generation. The current constraint cascade suggests AI growth rates may moderate not due to lack of demand or algorithmic limitations, but due to fundamental physical infrastructure constraints. This reality is already influencing capital allocation decisions and strategic planning across the technology sector. For traders, the key insight is this: the easy trade was buying GPU suppliers when compute was the bottleneck. The harder trade is identifying which memory suppliers, storage innovators, networking specialists, and power infrastructure plays capture value as each successive bottleneck emerges. The companies that secured multi-year supply agreements for HBM are positioned differently than those competing on spot markets. Data center operators with committed power capacity hold structural advantages over those stuck in 7-year interconnection queues. This isn't about picking winners in a single constraint. It's about understanding the entire cascade and positioning across the stack. The resolution of each constraint reveals the next limitation, creating a cascading series of bottlenecks defining AI deployment patterns through the remainder of the decade. Organizations that recognize and plan for these interconnected constraints will be better positioned to capitalize on AI opportunities, while those focusing on individual components may find investments constrained by bottlenecks elsewhere in the infrastructure stack. The ultimate challenge is not technological but logistical, building integrated infrastructure necessary to support AI at scale requires coordination across industries, regulatory frameworks, and timescales extending well beyond typical technology development cycles. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.